The first thing that disappears in a war between China and Taiwan isn't territory, it's time. Not metaphorically, literally. Because the global economy runs on something fragile and almost invisible: perfect timing. Ships arriving exactly when factories need parts, chips delivered exactly when companies need to build, money moving exactly when markets expect it. Break the timing, and the system doesn't bend. It locks. Now imagine this. It's 2026. Tensions finally snap. Military conflict begins in the Taiwan Strait. Within hours, shipping routes freeze, insurance prices explode, ports hesitate, satellites get jammed.
And somewhere, thousands of miles away, a factory shuts down. Not because it was attacked, but because a tiny component never arrived. This isn't just a regional war. It's a stress test of the entire global economy. And most people don't realize how little margin for error there actually is. Right now, Taiwan produces over 60% of the world's semiconductors and more than 90% of the most advanced chips. These aren't just tech parts. They are inside everything: phones, cars, power grids, medical devices, military systems, even the servers that run financial markets. No chips, no production. And no production means no revenue, no growth, no stability. Now here's where it gets uncomfortable. The world already runs on a just-in-time system.
That means companies don't stockpile months of inventory anymore. They keep things lean, efficient, fast. Which sounds smart until something breaks. Because when supply stops, there's no buffer. Factories don't slow down, they stop. So if Taiwan's chip exports suddenly pause, even for a few weeks, you don't just get a tech shortage, you get a chain reaction. Car production drops in Europe. Electronics factories stall in Asia. Tech companies in the United States miss earnings targets. Stock markets don't like uncertainty, but they hate supply shocks. Prices swing, investors panic, liquidity dries up, and then something more subtle begins to happen. Credit tightens. Banks become cautious. Lending slows. Businesses struggle to roll over debt. Because here's the part most people don't see. The global economy isn't just built on production, it's built on confidence. Confidence that goods will arrive, that payments will clear, that tomorrow will look roughly like today. War breaks that assumption instantly. Now add another layer. The Taiwan Strait isn't just about chips. It's one of the busiest shipping lanes in the world. Roughly a third of global trade passes through nearby waters. If conflict escalates, commercial ships reroute or stop entirely. Insurance companies may refuse to cover vessels in a war zone, and without insurance, ships don't move. It's that simple. So now you don't just have a chip shortage, you have delayed energy shipments, slower raw materials, rising transportation costs, which means higher prices, almost everywhere. Inflation spikes again. Central banks face a dilemma: raise interest rates to control inflation and risk crushing already fragile economies, or keep rates low and let prices spiral. There's no clean option. And that's where the financial system starts revealing its deeper structure, because beneath all of this is debt, massive amounts of it, governments, corporations, households, all relying on continuous growth to stay manageable. But war doesn't just disrupt supply, it disrupts growth. And when growth slows, debt becomes heavier, harder to service, harder to refinance. So defaults start creeping in, quietly at first, then all at once. Now, here's the irony. For years, global markets have been aware of this risk. Everyone knows Taiwan is critical. Everyone knows the system is fragile. And yet, very little has changed. Why? Because efficiency is profitable and resilience is expensive. Building backup chip factories takes years and tens of billions of dollars. Stockpiling inventory ties up capital. Diversifying supply chains reduces margins. So companies and countries delay. They optimize for the present and hope the future behaves. Until it doesn't. Now, let's talk about the financial battlefield. Because a war between China and Taiwan wouldn't just be fought with ships and missiles, it would be fought with money. Sanctions, asset freezes, trade restrictions. The United States and its allies could restrict China's access to global financial systems. China could respond by limiting exports, selling foreign assets, or disrupting supply chains even further. And suddenly, global finance becomes fragmented, less connected, less predictable, which is dangerous because the system was designed for the opposite. Now zoom out. This isn't just about a single conflict. It's about how tightly the world has been wired together. For decades, globalization made things cheaper, faster, more efficient, but it also made everything interdependent. So when one critical node fails, the effects don't stay local. They spread, fast, and sometimes uncontrollably. The uncomfortable truth is this: the global economy isn't built to withstand major shocks. It's built to function perfectly under normal conditions, which is why a conflict in one narrow stretch of water could reshape everything, from tech prices to interest rates to job markets. And yet, if you listen to public conversations, the focus is often on military outcomes. Who wins, who loses, which side gains territory. But the deeper story isn't about victory, it's about disruption. Because even a short conflict with no clear winner could leave lasting economic damage. Supply chains don't instantly recover. Trust doesn't instantly rebuild, and markets don't easily forget systemic shocks. So the real question isn't just what happens if war breaks out. It's this: if the global economy depends on fragile timing, concentrated production, and constant confidence, then how long can it keep running like this without something breaking first?